The Reserve Bank of Australia has been able to pursue tighter monetary policy than the majority of the developed economies in the world, but the benchmark rate has been now left at 4.75% since November, and some analysts are actually predicting loosening over the coming months. Hugh McKay from Westpac joins me now from Sydney. Hugh, what is the outlook for this meeting?
Well, we actually think they'll leave interest rates on hold at their meeting on Tuesday. We see that inflation is certainly a concern. The most recent observations have both annualised to rates well outside the Reserve Bank's target band, but we feel that developments elsewhere in the economy, notably in the household sector, and also the turbulence we're seeing in financial markets internationally, should be enough to keep the Reserve Bank on hold in the month of August.
With rates comparatively high, how much of a concern is the strength of the Australian dollar for the RBA?
Well, I think that when the Australian dollar does move quickly, the markets always start to think that the currency might be a constraint on the Reserve Bank's interest rate actions. That is possible, but it always depends on why the Australian dollar is moving. If it's moving because the Australian export prices are charging higher, well, the Reserve Bank will just see that as a very natural development. It may well constrain them at the moment, though, because they may well see movements in the Australian dollar as reflecting weakness elsewhere. And we're in a situation globally where there is no real compelling reason to own euros with sovereign debt problems in southern Europe, and there's also very few compelling reasons to own the US dollar because of the problems with politics there and a long-run fiscal outlook. So the Australian dollar, almost by default, is rising, and that doesn't say anything about our fundamentals. So that's the kind of situation where the Reserve Bank might express some concerns about rapid currency appreciation.
And what are your expectations going forward? Are you anticipating any hikes in the coming months?
We don't think that there will be another rate hike in this cycle. We have to run the gauntlet of the most recent of the upcoming meeting, where there is a non-zero possibility that they do hike, but we think that would be a mistake. And if they do not raise interest rates at this meeting, we don't really see where they would get another opportunity to do so before they actually start to move interest rates lower, possibly in December of this year. We just think the household sector in Australia, the housing construction cycle, the retail sector, all the interest rate sensitive elements of the Australian economy are under considerable pressure, sending a signal that interest rates are too restrictive and they should be recalibrated, and they should be just on the expansionary side of a neutral rate rather than on the restrictive side.
So although the Australian economy has been one of the best performers out there are soft patches, and the housing market is one of them.
Well, the household sector is showing great anxiety in relation to the fact that they still do have a large legacy of debt that was accumulated during the global credit boom of the first 3 quarters of the 2000s. And they are starting to express some misgivings in an environment where cost of living pressures are quite pronounced. But it's worthwhile noting, though, that the cash rate in Australia is 4 3/4%. And if you think about where interest rates are in other developed markets, nobody else actually has a restrictive interest rate setting at the moment. Everybody else has extraordinarily accommodative monetary policy, which is really assisting the fiscal policy side of the accounts to consolidate. In Australia, we have very, very rapid fiscal consolidation, about 4 percentage points of GDP over 2 years, plus we have restrictive interest rates. So it shouldn't really be a surprise that the sectors of the economy which are feeling the heat of tighter policy are starting to adjust their behaviour, and they're really clamming up, particularly the consumer sector. So we actually think the policy settings in this country are too tight. The international environment does not call for it, and increasingly we don't think the domestic environment calls for it. Even though we do have a very large pipeline of mining investment projects coming down the line, we don't think that the distribution of the income which is associated with those projects will be sufficient to push the household sector out of their current funk.
Okay, thank you, Hugh. The RBA will announce their decision at 4:30 GMT on Tuesday morning, but for now, goodbye.